We've had quite a busy week across the globe. Friday's non-farm payroll figure was a major disappointment as the US added only 38,000 jobs. A June rate hike is now completely off the table, and it might not even happen in July either. The economic calendar for the week ahead is much lighter. In Japan, first quarter final GDP data will be in focus. Japan's GDP is expected to have grown by 1.5% annualised in the first quarter. The market expects no revision to that number, but more importantly, we will be talking about the delay in Japan's sales tax hike. Prime Minister Shinzo Abe has delayed the sales tax hike again this time by more than 2 years. The hike from 8% to 10% was meant to happen by April 2016, then by April 2017, and now is expected to take place by the end of 2019. Interestingly, the market reaction was not as expected. The yen gained and the Japanese stocks lost. The market priced in the rise in solvability risks rather than a potential positive impact of fiscal expansion. One thing is for sure, as monetary policy actions lose their efficiency, it was necessary to pull the weight off the Bank of Japan's shoulders. Fiscal measures were definitely needed, not only to reach the 2% inflation target, but simply to boost growth. Now, despite the appreciation in yen, stimulus will bring more money into the market, and this should weigh on the currency. From a trading perspective, the dollar-yen dipped to 108.50 this week. Trend and momentum indicators remain negative, suggesting that the current sell-off could bring us lower toward the 107.8 figure, which is the 61.8% Fibonacci retracement on the May rise. But at some point, the monetary fiscal combo cocktail should help the dollar-yen move back toward the 110 level and even higher. OPEC failed to reach an agreement again, and now it's becoming an expensive game. Rising financial pressures, bringing the world's most cost-efficient producers to raise debt to cope with the cost of extending their market share at the current market price. Abu Dhabi sold $5 billion worth of government bonds in April, as Saudi Arabia is preparing to issue $15 billion worth of bonds by early July. It seems to be a good time to sell debt, as it gives a good alternative to investors looking for returns in this low-rate environment, while avoiding highly volatile stock markets. In this context, WTI will likely see resistance pre-$50, as fundamentals haven't changed and the global oil glut will continue pressuring prices to the downside. It's possible that we see a weakening towards the $47.4 mark, which is the May 23rd low, and if cleared, this could pave the way towards $45. Next week, the Brexit referendum will continue to make headlines as it's only 3 weeks away now. And next week's manufacturing and industrial production data could confirm weakness in activity in April. UK's trade data is also due out next week. The deficit may have improved according to the consensus, yet with the moderate economic growth and Brexit uncertainties, we may expect the pound to remain under pressure. At the end of the day, the UK's current account deficit is 4% of its GDP, and about 40% of its goods are sold to EU countries. So in the wake of the Brexit vote, there is little reason to be too enthusiastic if we see slight improvements. The pound should continue being a good sell the rally. Extracting the implied probabilities from the cable spot price, the 1 spot 44 level suggests that the market is pricing in a 40% probability for Brexit. 1.42 corresponds to a 50-50 chance. If the pessimists jump back in for any reason, such as a new poll, bad economic data, cheaper oil prices or a better bid US dollar, we could technically expect a further slide toward this level. Well, that's it for today's week ahead, but join us again next week. Bye for now.